Okay, great. Thanks. So our topic A, professional, legal, and regulatory environment. And just briefly, the meaning of audit. Like it has not changed the way it has been at level 2. It's still the same definition and explanation. Auditing and any other assurance service are engagements in which a practitioner expresses a conclusion designed to enhance the degree of confidence of the intended users about an outcome of evaluation of or measurement of a subject matter against the criteria. You will notice that auditing comes in because there is need to give assurance to someone else, okay? And auditing is an independent examination, okay? So we know that organizations are managed by people who are not the owners. And these people who manage these organizations act as stewards of the shareholders, okay? Acting as a steward means that you're that you're managing a resource or you're managing financial resources on behalf of someone else. So if you are employed and you are in charge of managing these resources on behalf of someone, you are very accountable at the end of the what? At the end of the year. And this accountability will mean that you prepare some of the reports. And the one that we will talk about mainly from a financial reporting point of view is going to be the financial statements. But look, these financial statements, we want the shareholders or the owners of the business to actually rely on them or to be confident about them. And that is what calls for an independent examination. And this independent examination is what we are calling auditing. So as the auditing is done, an opinion has been issued, then the users of these financial statements will look at them more confidently than if they were not actually audited. So looking at the role of auditing and other assurance services is more of oversight. So I mean, the auditors make sure that people who are looking after these organizations, people who are running these resources, they do them and they do what they are supposed to do, because they will know that at the end of the day, someone is going to come and look at what they have been doing, and someone is going to express an opinion, someone is going to express comments. So this kind of oversight or this kind of independent review and examination helps to make sure that people do what exactly they are supposed to be doing. Then we have detection.
I think, excuse me, sir. I think, is it oversight also done by, I think, both the internal and external, right?
Yes. Yeah. So there is the kind of oversight that the people like the board of directors are going to do, okay? And then but remember, this oversight that the directors are doing, these are the people who are going to be reporting to the shareholders at the end of the what? At the end of the day, okay? So even the shareholders would want to know if those charged with governance are doing what they are supposed to do. So in such a way, the auditors are like the final oversight on behalf of the what? On behalf of the shareholders. And of course, detection. The auditors are going to help you to detect any inappropriate, fraudulent, illegal, or any acts that could be happening within the what? Within the organization. If there's anything happening that is not appropriate, the auditors could actually help you to identify this. And then deterrence. Deterrence basically is to reduce, okay? By them looking at your controls, they are going to help you to reduce on the weaknesses in internal controls. They are going to be looking at things like proposed changes in the laws, implementation procedures, and they are going to help you to make sure that you are complying with these things. So deter comes from like preventing or stopping. If the auditors are going to come and review like some of the contracts, they're going to be able to identify if there's like any conflicts of interest, and that can be dealt with if it is reported on by what? By auditors. Inside.
And I also think,
Yeah.
and also think also deterrence in a way that if people know that auditors are going to come, they also want, they can't hit the steel if they know people can audit.
Yes. Yeah. So there's really like many ways in which this is done. If you know that someone is going to come and look at what you have been doing, you're going to have to be more careful. Okay. By them assessing your controls, I don't know if you've seen that some of the reports issued by external auditors, on top of issuing an opinion on the financial statements, ISA 265 requires external auditors to report any material weaknesses in internal controls that they have noted during the course of their audit. Okay, so if they come to audit your organization and they notice that maybe you're not doing bank reconciliation statements, there is possibility of fraud happening. People might steal some cash and you do not know because you're not reconciling your bank balances. So this is something they can report so that those charged with governance actually enhance the controls and make sure that reconciliations are happening. And because of something like this, they're going to prevent anything that could lead to fraud, anything that could lead to corruption, anything that could lead to financial loss on the side of the what? On the side of the company. Yeah. Then I think that auditors do is really insight. They help you to, give you like to help you look ahead, to give you new knowledge, and to give you feedback that is going to help you to improve your operations. It could be like a new tax amendment. I don't know if you've seen external auditors try to do some publications that explain some of the new developments, like in the financial reporting, in the accounting treatment. Some hold even tax seminars and accounting seminars to help pass on this message and pass on this information to their clients. The other thing that you will notice is that most of the auditors are going to be dealing with different organizations. They have looked at different policies and practices. They could actually benchmark and recommend to you the industrial best practices that will help you to do what? To optimize your operations and improve your operations. It could be from a management point of view. It could be from an internal control point of view. It could be from a corporate governance point of view. They could even review your policies and say, hey, this does not seem to work properly. Could you amend it to look like this? By doing that, they are inciting you into some of the best practices that could actually help to improve your operations significantly. And then, of course, foresight is basically like helping you to plan ahead. Very good example is like bringing to you from inside. They can help you to look ahead. It will be like new developments in the financial reporting. Like right now, we are in 2021, and we have a new standard coming on board soon. That is IFRS 17. That is insurance. Okay. And most of the organizations that are affected by this particular standard, that is going to be specifically dealing with accounting for insurance contracts, they have already started planning ahead for how this is going to affect their processes, how this is going to affect their businesses, and how this is going to affect their financial reporting processes. And they are able to come up with strategies on how they are going to have to adopt and implement this. If it needs coming up with new technology, some are already trying to come up with the technology in form of systems and science that is going to help them to do what? To adopt this financial reporting requirement more smoothly without a lot of difficulties. So let's look at some of the benefits of audit and data assurance services. What does it help you? Do you just come and do an audit and go away, or is there something that is going to add to your business? From the shareholders' point of view, they find this information more reliable. Okay, so it gives assurance to the shareholders. Okay, because they are not involved in the business, and therefore they can only be confident if someone independent says that this kind of information you're getting is actually true and fair. Then it helps to enhance credibility and reliability of the information that we give to stakeholders. We all know that if you're having turnover exceeding 500 million, from the tax laws of Uganda, you're supposed to file using audited financial statements. Okay, so the URA is not interested in anything, but they're just trying to make sure that you are giving them information that is true and fair, not information that is biased, understated, or overstated, or anything. Okay, even other regulators and investors, if you are going to the bank to get a loan, for example, as a business, one of the requirements they're going to ask you to provide them with is going to be the audited financial statements. They just want to make sure that they are using information that has been audited, that has been looked at by someone, and that has been confirmed to actually be making sense. Then, advice from external auditors can actually yield financial benefits for what? For a business. For example, if someone says that you need to improve your internal controls on stock, otherwise you're going to be losing stock, or you're going to be having fraud, and people are going to defraud the business, that is very beneficial to the what? To the company, to the operation that you're going to be what? You're going to be auditing. So auditing will bring recommendations on your processes, on your systems, that is going to help you to improve your operations. If there are any inaccuracies and discrepancies in the organization records, they can be detected and corrected by audit. Entities internal control systems. We have just talked about ISA 265. When auditors review your operations and make recommendations, this is going to enhance your operations. This is going to improve your internal control systems. Then it also helps you to identify areas that need improvement so that you can make proper adjustments. This is still from the recommendations that external auditors provide. Then it helps shareholders and suppliers to be assured that the risks in their organizations are well studied, effective systems are in place, and to handle them. You have seen most of the shareholders wanting, for example, external auditors to be present on shareholders' meetings and present some of the reports, some of the observations they have made. It's not for any other reason, but just to make sure that they are more comfortable, that they have someone who is actually ensuring that their operations are running in a proper and effective manner. And of course, entities' profitability and efficiency could actually be improved because of these recommendations that are going to enhance the working and financial systems in these organizations. So you don't just do it for fun, or it's not just an exercise to say that, oh, we have carried out an audit, but it's rather something that is supposed to be adding value to these operations and making sure that the organizations that are being audited are actually benefiting something, and they are getting value for the service that is
and I also think they can help. I also think they can help also to protect a company from litigation. For example, in case, as you have said here, where they uncover inaccuracies and discrepancies, it can help a company. Cost in litigations, what and stuff.
Yeah, you might have to bring it in like a little more explanation. Definitely, If these inaccuracies are detected and corrected, it means that the stakeholders are going to have accurate information. And if they have accurate information, then you won't fall a victim into issues or things like litigation, being sued that you misrepresented the information, because it has been looked at by a professional person, by an external auditor, independent, and he's actually made sure that you're submitting something that is true and fair to any stakeholder. Yeah, thanks for that addition. Okay, so let's look at the types of assurance services. We have reasonable assurance engagement and limited assurance engagement. With the reasonable assurance engagement is a kind of assurance engagement which is done with the aim of reducing the risk of material misstatement to an acceptably low level, okay, in circumstances of the engagement as the basis for forming a practitioner's conclusion. But then limited assurance engagement, it is basically to reduce the risk to an acceptably low level, but the risk is greater than for a reasonable assurance engagement for a negative, and that is the basis for a negative form of expression of the practitioner's conclusion. We will see later on in a particular, I think in a chat somewhere, that reasonable assurance engagement gives you an opinion, okay? But limited assurance engagement is going to give you a conclusion, okay? The risk is greater for a reasonable assurance, okay? But the risk is lower in a reasonable assurance engagement. By reasonable assurance, we mean it is 95% and above. But with limited assurance engagement, it is below 95%, okay? I'm sure you must have seen before in your paper 12, why in audit we give reasonable assurance engagement, not absolute assurance. In audit, they do not give you 100% assurance, but rather they give you a reasonable assurance. Okay.
Assurance.
Yeah. And the reasons as to why we do not give reasonable, so why we do not give absolute assurance, it's because of some of the inherent limitations of an audit. Things like in auditing, we use sampling, and of course, when you use a sample, you cannot because you have based on what? On a sample. Some of the things in accounting and reporting are really subjective rather than conclusive. We can have same companies, same nature of business, but one is depreciating his fixed assets, maybe computers, at a rate of 25%, and the other one is depreciating at 30%. But nobody is really correct. Nobody is wrong. They are all correct. So there is that acceptable kind of difference, and that is why we say that we cannot give 100% assurance. Either way, on the other side, when you come to the URA, they are going to say you depreciate your assets on 40%. I think they also have basis why they think you should depreciate like computers in class 1 at 40%. So those are some of the factors as to why we cannot give 100% assurance. The other thing, of course, that we can't give, why we can't give 100% assurance is the fact that management may not give you all the information you need, either intentionally or unintentionally. There is information they might not give you, and you will never know about it, but it's somehow related to the financial reporting of the organization. And of course, not forgetting that if there is any fraud that is intentional, okay, fraud is always intentional. If there is any fraud that management has carried out, they will try to make sure that they use all the possible schemes to conceal it, okay? So in such a case, you might not be able to do what? To detect it. And because you cannot detect it, then why should you be giving an absolute assurance? And hence you just have to give reasonable assurance. Okay. Yeah. So let's look at examples of audits. We have external audits. which is the independent examination of financial statements, to express an opinion as to the truth and fairness of these financial statements in accordance with the IFRS or IFRS for SMEs. Then you have internal audits. Internal audits is mainly like an internal appraisal activity that is aimed and undertaken of improving the organization's operations in terms of internal controls, risk management, and governance related matters. The objective is to make sure that you achieve the organizational objective. So internal audit is done by the organization with the aim of improving their what? Their operations.
Operations.
Yes. And then we have forensic audits. Forensic audits, do you know what forensic audits are?
Yeah, forensic majorly are about like investigative audits, isn't it?
Yeah.
Sort of forensic. It's like investigative audits, right?
Yeah. The main thing when we talk about forensic audits is that these have legal implications. Normally, forensic auditing or forensic accounting, you're going to carry out this audit, you're going to carry out this accounting to gather information, to gather evidence that is going to be used to solve the legal dispute. So that is what a forensic audit is really like all about. There is something legal involved, and we do them to make sure that we help to solve legal disputes. There could be fraud involving misappropriation of funds. That's why we do forensic audits. Quantification of loss in cases of insurance claims. In case business partners are quitting and there's a dispute, then there is how to determine the profit share. Then if there's any claims of professional negligence to an accountant, we can carry out a forensic investigation. And more to that, evidence from a forensic audit can actually be used in court of law to solve financial matters. So, in public sector audits, these are audits on state-owned companies and institutions. And this is always a requirement by the laws of what? Of Uganda, for example. So the Public Finance Management Act requires that all public entities, companies, governments, and everything are looked at, have audits conducted on them under the supervision of the what? Of the Auditor General, which is the body that is there to ensure that there's proper public sector accountability and promotion of transparency in utilization of public funds. So, and of course, tax audit. Tax audits is fair. It is performed to make sure that we assess the accuracy and completeness of the tax returns filed by the what? Filed to the authorities. That is why we do tax audits. Tax audits could be done by the URA, or they could actually be done by professionals. For example, tax health checks to see if your tax filing is correct, accurate, up to date, and if there are any outstanding liabilities that you need to resolve with the tax body. So, then environmental and social audits. This is like really a recent development, and it's a very, not a very popular thing, but of course it is becoming relevant in everyday today life. And this arises from the fact that some of the companies would want to report and give status on their environmental and sustainability as part of their annual reports. Okay, so because of this, it means that there is need for someone independent to actually look at these environmental and sustainability reports that these organizations are issuing. So because of all that, it calls for environmental and social audits to actually be relevant, and they are agencies out there and organizations that actually do what? That actually provide this kind of service. If you look at people who operate, for example, fueling stations, before your license is renewed by Ministry of Energy on an annual basis, you have to present a report or an environmental audit report describing operations and whether you're actually operating safely within the environment where you operate. If you look at all manufacturing organizations, they have to have environmental audits done on them from time to time to make sure that they are not actually affecting the environment where they are operating. Think about companies like Uganda Breweries, Nile Breweries, Movit, these guys, some of the substances and some of the waste products into our environment. So environmental audit is there to make sure that they are not actually harming our environment and they are not harming the society where they are operating. So in compliance audits, it's really more like specific to some organizations and specific to some of the laws and regulations. So compliance audit is basically done to make sure that you are complying with certain processes, certain procedures, certain laws and regulations that you're supposed to be complying with. For example, when commercial banks prepare returns that are submitted to the central bank, it is a requirement, okay, by the central bank to have these returns reviewed by the external auditors. This is to make sure that these returns they have prepared are complying with the what? With the Financial Institutions Act, okay? You could actually carry out a compliance audit within your operations. Maybe you have a finance manual that you should be complying with. You could do an audit of your operations to confirm if everything is compliant with what? With the finance manual that you are using as the organization and many other things. As long as you have some laws, you have some regulations, then you can actually do a compliance audit to see if everything is being adhered to. And then value for money audits, these are basically done to assess efficiency, economy, and effectiveness. We normally refer to them as 3 E's when using organizational resources. This is very popular in public sector because this is where you are using people's money as well as in the not-for-profit organization. So value for money audits is done to make sure that the resources are being used efficiently, the resources are being used for the right purpose, and they are being used and we are getting benefit. We are getting the right amount of benefit for each coin that we spend as an organization. So,
but excuse me, what is the difference between economy and efficiency?
Efficiency, efficiency means that you are using them like you're not, like you are using them for the intended objective. Okay.
Yeah, okay, you're running like 90%, like turnover like that, something like that, good turnover. But
economy means that you are getting, like you're being, people normally like using the term being economical, okay? I don't know if that's right English, but basically you are not, like you're getting like you're getting you're
not wasting,
not wasting, like you're spending less and achieving more. Yeah, that's what
I get you. Thank you.
Yeah, that's what economy is like really all about. Efficient, like efficiency, you're looking at, am I using these resources properly? Am I using
Right.
like, am I using these resources to generate value? It can also have like an aspect of quality, okay? But economy is making sure that you spend less and get more. If, for example, I can spend 1 million and I buy, okay, let me say, if I can spend 30 million and maybe buy a vehicle for the business, okay? I can spend 30 million and buy a vehicle for a business that does work for the business, but someone else could also come and he spends 100 million and he buys a vehicle that does the same purpose, same everything for the same what, for the same business. We would say that the person who spent 100 million is not being what? Economic, like he's not spending these resources economically. Whereas the guy who spent 30 and he can do all he needs to do, we can say that he's being what? He's being, like, he's not being extravagant with the resources of the what? Of the organization. Whereas efficiency, we are looking at quality of every penny that you are what? That you are spending. So, okay. Subsection C is really like just too much wording there. You can read through during your free time.
But I haven't got the book. I'm still waiting. I don't know when she's sending them.
I can send you the different, I don't know if she's prepared printed material. Is it okay if I send you just the different topics in their order?
It's okay. It's okay.
So,
I'll be reading after class, then I can use those notes.
Yeah, I will email you this just right after this class. So let's look at professional skepticism as a term in audit. Professional skepticism is basically, it refers to being alert, okay?
Yeah.
Or being like having a questioning mind. The best way I can explain it is saying that if someone has given you his financial statements to audit, at the back of your mind, you know that these financial statements are all wrong, not until you audit them and you confirm that they are not what? They are not wrong. Okay? If you don't have that kind of thinking, then you will not look at them with the attention that they actually do what? That they actually need. You need to be alert to any information that makes you question the reliability of this information that you're using. It could be audit evidence that contradicts other evidence. Maybe someone has told you that the reason as to why our revenues increased, it's because we got new customers, okay? When you got the audit receivables, you should find that the customer listing has actually increased, okay? So if the guy tells you auditing revenue, that our revenue increased because we got new customers, and then when you got audit receivables, you find that there's no new customer actually, then it would mean that these two responses you have from the client or explanations are contradicting themselves. So if you are very skeptical, you'll be like, first wait. This is what I was told when I was looking at revenue. How comes it's different when I come to audit receivables? So you need to have that kind of being alert, and you're very very skeptical. You don't just take anything for what it is or for what they have told you, but rather you are more intuitive. Like you're trying to ask a question,
cautious,
why, how, and you're very keen to whatever responses you're actually getting. So it basically means being alert to audit evidence that contradicts other assurance evidence obtained, information that brings into question the reliability of the documents and responses, then conditions that may indicate fraud. As someone might give you some of the support documents, maybe the support documents are like you can look at them and you're like, hey, this doesn't really look correct. This doesn't make sense. It could be just the procurement process. And maybe when you look at some of these documents, they really don't look like the documents you have seen out there. I have seen someone provide a trading license, which does not look like the normal trading licenses, that even when you look at it, it looks to be like fishy, like it doesn't look to be true. Okay, so you would automatically notice that this is not making sense. I'll give an example. There's a time I was auditing one of the hospitals. It was actually not in Uganda, in a different country, and I was looking at performance-based bonus. Employees get bonus like on every month. So, but this bonus, you get it depending on how you perform. If you perform 80 and above, you get your full bonus. If you perform below 50, you don't get any bonus at all. So when I was looking at their information, I noticed that from their HR, from their bonus sheets, their bonus calculation sheets, everyone was having 90, 95%, 100%, 98%, 80%, 95%. And it was looking very, very weird. And I just thought about it critically. I'm like, but how comes in this company, everybody is a good performer? Everyone has 80 and above percent. This should be one of the most efficient organizations like I have ever come across. But it was definitely very, very inefficient because the finance department itself was really like not performing well. And there was a lot of errors in the financial statements, a lot of reconciliations not tying up, like a lot of issues with the financial statements. So, and I was trying to relate to the marks that I'm seeing and what I'm actually seeing in the organization. And given that it was even a government entity, it was really not an entity where you expect people to be getting 190%. So I asked the HR person, I'm like, how comes all your employees are good performers? Like you really don't have anybody who performs poorly? And it was a question of if all your employees are this good, then you should be running one of the most efficient and one of the perfect like hospitals in the world, in the whole of Africa. So I'm like, it doesn't really like, it's not convincing. I'm really not convinced that everybody can score above 90%. The HR person was very frank. He's like, if you don't give these people 90% and above, they won't get their bonus. And if they can't get their bonus, then their salaries are going to be low because it's a requirement from the government.
It was about making that high so that they can survive.
Yes. So it's a requirement from the government of it's one of the neighboring countries in that's Rwanda, that not all employees' salaries for the public service, specifically in the Ministry of Health, are flat. If your salary is like 5 million, they're going to make sure that 3 million is your flat salary, and then the 2 million will be taken as performance-based bonus, which really like entices you to work harder, so that if you perform well, you get your full salary. If you don't perform well, then you get only the flat salary, then the additional, which is like an incentive. You do not do what? You do not earn it. So when you told me that, then I realized, yeah, this is exactly what I was looking for. Like there was something wrong with the performance evaluation as scores. So that is an indicator of what? Of fraud. So if you're a skeptical person, you will think through it. If you're not skeptical, you will like, okay, these are the performance, they are appraisal sheets, signed off properly, done in the right channel, and off you go. But if you're very skeptical, there's a lot more that you can actually come up with compared to just taking things for what they are. Okay, then of course, not forgetting circumstances that suggest the need for audit procedures in addition to those required by the ISAs. In some instances, you could actually carry out your audit procedures, but then you realize that depending on the information you're getting, you feel you need to get more information. Someone could give you like a scanned document, maybe on soft copy, and then you're like, no, I want to see the original agreement, because the scanned copy does not look really like very convincing. So, that's what being skeptical is really all about. It helps you not overlook any unusual circumstances. It helps you to not overgeneralize when you're drawing your conclusions. It helps you not to use inappropriate assumptions in determining the nature, timing, and the extent of audit procedures and evaluating some of the results. So that is professional skepticism. Let's look at professional judgment. Professional judgment is using of knowledge and
Experience.
when you're applying, when you're interpreting and making conclusions over some of these issues or some of these decisions. So professional judgment should be used or will be used during the audit, and it should be well documented. There are some specific areas where we use professional judgment, like determining materiality and audit risk, determining the nature, extent of audit procedures, and evaluating whether sufficient and appropriate audit evidence has been obtained, and evaluating management's judgment and then drawing conclusions based on the audit evidence obtained. Basically, there are aspects which are really like, there's no right or wrong answer, but it really depends on professional how you see it. For example, determining materiality. Do you know how we determine materiality? In accordance with Isaiah 3:20, materiality is really basically determined, looked at using like what are the interests of the users of the financial statements. Okay, that is what is going to drive what is here when you're carrying out an audit. And what really the interests of the users of the financial statements are is going to vary from one entity to another. Okay, it's going to vary depending on the circumstances, and therefore you as a professional, you're going to have to use judgment when determining this. We, for example, all know that if I am dealing with a not-for-profit organization, the major interest of the users of these financial statements is going to be whether the resources have been used, like if the donor funds have been used appropriately, economically, efficiently, and appropriately. So, whereas if I'm dealing with a profit-making organization, the interest is going to be how much profit have we made at the end of the what? At the end of the year. If you're dealing with a startup, the interest is going to be really, is the company growing? Because we have started this operation, but we want it to do what? To grow. So so the interest of the shareholders is going to be growth in the what? In the top line, or that is in the revenue of the organization. So therefore, it's going to vary, and how you determine that is going to depend on your knowledge, your experience as a what? As a professional. Nature, timing, and extent of audit procedures, typically this is very judgmental. When it comes to whether you have sufficient evidence, this depends on what you have seen and what you think. Like something to be sufficient is going to depend on what you have seen and how you're looking at it. So it's really a case of what do I think, what do I know, and what is my knowledge and experience actually telling me. And then when you're looking at management's judgments, when they're applying these financial reporting regulations, you're going to have to use what? Judgment. I just gave an example of when you're depreciating assets. Someone is going to come and use 25%, someone is going to come and use 30%, someone is going to come and use 20%, but both of them are actually what? Correct. So what have they based on, and what do you make of that as an external auditor? So, okay. I want us to take a break of like 5 minutes, and then we'll be right back just after that. Sawa.
Okay, thank you.
Okay. Okay, great. Let's look at subsection D. Why do we need audits to be performed by people who are independent of the organization? No, are we together?
Yes, sir, we're together.
Okay, great. Thanks. So we all know that businesses have a wide range of stakeholders, and this could include security agencies, suppliers, customers, lenders, potential investors. When it comes to public listed companies, the public, and then we have regulators, tax authorities, advisors. I mean, there's many stakeholders that these entities are supposed to be reporting to. And because of the very many stakeholders, it's possible that different people are interested in really different things. Okay, and as such, an independent person will make sure that he balances between the needs of different stakeholders. If I am a shareholder and I pay less tax, okay, I will benefit because my dividend is going to be high. But if I pay less tax, then I'm going to be doing a disservice to the tax authority. Okay, so this is why an independent person needs to come in, because for him he's independent. He's there to make sure that everything is done in the right manner and the way it is supposed to be done. So that is why we need to have an independent person carrying out these audits, and not a person who has some other interest in the organization. And there's a few reasons to that. The audit reports prepared by owners may not disclose fraud in the entity, as this may not work in their favor, and therefore an external person is in better position and act some of these are issues. If I know that something is not going to work in my favor, say like fraud, I won't talk about it. I'll just pretend like this didn't happen. If financial statements are prepared by an insider, they might contain some errors, and they can only be corrected by an external person. The annual report may fail to disclose all the relevant information required by stakeholders. So their focus may be on management and owners, but they forget that we have other stakeholders like providers of finance, like the tax authorities, that also need to do what? To be catered for. And then the annual reports may not meet all the requirements of the respective regulators, okay? Because it is what you're interested in as an insider, but you forget that there are many other stakeholders out there who are going to be looking at these financial statements. All right, some of you have looked at management accounts. Normally, management accounts are not going to be meeting the needs of many stakeholders. They can only meet the needs of a few internal people, okay? And, because of that, you find that it is very important that an external person actually carries out the audit to make sure that the financial statements that are going to be issued are meeting the needs of a wide range of stakeholders. Management of the entity may also choose to deliberately mislead the users. I have seen quite a number of people who say that I don't want to pay tax to the URA. Okay, so make sure that my profit is small. So this organization has basically decided to mislead the users of the financial statements. Not forgetting that in some instances, management may not be very competent to make sure that the financial statements are okay. They might mislead users unintentionally, not intentionally. So if we're supposed to be looking at the International Audit and Assurance Standards Board, but I really don't think we should be spending a lot of time. This has not changed. The standard setting process is the same. And the ISB is the one that is really in charge of this. And It can be research and consultation, transparent debate, exposure draft for public comments, and then consideration of the comments, and then you have final approval. But really, that you can look through at your own.
Yes.
Yeah. Audit quality, there's just a few comments about audit quality. You can look through that during your free time. Authority and of the national and international standards. Just maybe something small to note on the fact that the accountants regulations of 2016, they give powers to the ICPAU to manage issues to do with accounting in the country. So that's one thing to note. When it comes to ICPAU, they also work with other international bodies like IFA, International Federation of Accountants. And this is basically to make sure that the accounting profession is working well in Uganda and even beyond.
Yeah, I wanted to ask you something.
Yes.
About ISPA, why do they charge us for that? Why do they charge us that 30,000 for conferences, Zoom meetings? Because I see
for conferences. Okay. Let me just let me. It's a very interesting question. Let me just put it this way.
Because
ICPAU is a body, okay, not for profit, and is in charge of the operations of the accounting profession in Uganda. Okay. Now, ICPAU, like any other body, they have expenses. Okay. And when you have expenses, you have to meet them. Okay. Now, this is what happens when you do your exams. You pay for them, not so. So you pay the exam fees and you pay the annual membership fees. That is to facilitate services that the institute is going to be delivering to the to the profession. Okay. Now the conference is when they come. This is continuous professional development to make sure that accountants and even aspiring accountants are trained and updated in matters that pertain in the kind of work that they actually do. If you will notice that this cost has actually gone down, okay? Before it used to be 100,000, 150,000. And the reason why it used to be that, it's because this used to be physical seminar training, where you go out to the hotel and, hire the hotel hall and get your people to come in, pay for their refreshment and all that. Okay, so that is like the facilitation, because I'm not going to bring you to this hotel and I pay and then you do not do what you do not pay. Okay, now this is now 30,000, but remember this 30,000, they still have like to put in, like they still have to put in their time, okay, to arrange for these seminars. They have to coordinate the material. They have to make sure that they have internet infrastructure to hold these seminars. You might look at it as just a seminar for 3 or 2 hours, but they have ideally spent something to do what? To actually coordinate it and mobilize it and make sure that it happens. Right? You get what I mean?
Yes, I get you.
Like, for example, I am teaching, okay? I am teaching from home. We can't say that I will not be paid because I'm teaching from home. That's an example. Yeah.
I get you now.
Yeah.
Okay, just my issue was you like okay when you die, you pay annual fee
Yes.
that one name something.
Yes.
Then I tell you pay Ugamba.
No, you want that annual fee to get a
Okay,
financial
but
statement. Anyway,
okay.
but definitely the overall objective is not really like for them to make any profit, but it's to make sure that they're able to deliver the services that they have to deliver to the what to the profession. And good enough, it's led by a team of accountants, not led by any other like people out there. So I wouldn't think that whatever they are doing is really like illegal or they are trying to make a profit here and there. And that's not really like the case. But it's to make sure that they at least they get um they get the money to deliver whatever they have to deliver to the what to the members of the what of the institute, both aspiring accountants and full members of the what of the institute. It's like in school. I remember when we used to be in high school, if the price for inputs increased, even the school fees would increase. So that's really like it really depends on what's the cost of running the facility, and that's the much fees that you can actually do what that you can actually charge.
And sometimes the school gives you also makes the PTAs to collect more money for buses. To be taking the bus.
I don't know, but that would be really a very different thing, yeah. But great. So
Okay.
audit failure. Audit failure. We looking at audit failing. Okay, you are there to make sure that the financial statements issued are free from material misstatements, but they are actually misstated, and you do not identify these misstatements or these issues during the audit. At the end of the day, you have issued a wrong opinion on these financial statements.
Is it the same as excuse me? Is it the same as audit risk?
um, I don't want
Okay,
to go.
some similarity because I know risk is probability, but failure is actual failure.
I would say that these are they will eventually lead. Audit risk leads to audit failure, so it's one in another. Yeah, it's one in another.
Sure.
Yeah, audit risk will lead
Okay.
to audit failure. Yeah. So what are the principal
Okay.
causes of audit failure? Things like practices of creative accounting to disguise the poor results and mismanagement. Normally, creative accounting people will make sure that they conceal their inappropriate accounting practices so that you do not actually do what detect them. If I was using a layman's language, I would say they cook the financial statements. And of course, they are going to devise schemes to misappropriate company resources. Somebody is going to come up with a process that is going to help them to actually make sure that they misuse the company resources. Then there could be some aspects of money laundering and then manipulation to the stock exchange by reflecting high share prices for a company just to lie the public, and the public invests in more money. Effects of audit failure. What does it mean if you have audit failure?
Of course, yes, and
Please, you can go ahead with the submission, Noah.
no, okay, I was just going to say that in case you have in case of audit failure, it can what? Also, you as a firm you can be taken to court. Audit firm, you say.
Yeah. Yeah, true. That's what happened. So there are going to be penalties, litigations, and fines on the firm. And we have had firms that have faced these litigations, and huge sums of money have been have been paid. So That's it. So on the other side, of course, entities have come up with, internal mechanisms to, to do what? To make sure that, these things don't happen, make sure that the organizations are well managed. And that is being really like spearheaded by ensuring that they adopt proper corporate governance practices. So corporate governance is going to make sure that they look at some of these issues and, make sure that these organizations are being managed and operated very well to meet the needs of the what? Of the stakeholders of the company. For example, supporting and offering oversight function to management through non-executive directors. Non-executive directors are those directors who are not involved in the day-to-day running of the what? Of the organization. Okay. So what does this mean to the organization? These come with independent views, independent ideas, and they can challenge management's point of view or how management is doing things. Then, of course, regular appraisal of management's performance in a fair and balanced manner. The board or principles of good corporate governance advocate for ensuring that performance management is looked at more keenly, because that's what's going to determine how the company is being managed and directed. And of course, setting and reviewing remuneration and benefits of management, making sure that people are paid well and paid the right salaries they're supposed to be paid. And then ensuring that accurate and comprehensive financial reporting, that's very, very key. Financial reporting plays a very instrumental role because people need information, financial information, to make decisions that are going to direct the what? The business. And instituting sound system of internal control and ensuring the implementation. You will have entities have like finance and audit committee, audit committees, all those are there to ensure that internal controls are strong and they are doing well implemented. And of course, creating a constructive relationship with shareholders of the what? Of the company. That is very, very key, because you can't be running someone's operation, but then you do not have a good relationship with that, with them. So that is what it really calls for. And some of these things are going to help ensure that there's no cases of audit failure and other related issues that could happen in some of these organizations. Our audit committee, the audit committees are really, it's really a subcommittee of the board, okay? And their role is really to make sure that they increase the public confidence in the credibility and objectivity of the audited reports and financial statements and any financial related information. These are the people who are going to be paying a little more detailed to things that are financial in nature, and then they can report this to the what? To the board, okay? They ensure that the board is meeting their responsibility with respect to financial reporting, and they also strengthen the independent position of the company's external auditor. We're going to see that later in their responsibilities. One of them is that they help or they oversee the operations of the entity's internal audit and external audit functions. So they are the ones who make sure that the audit function, both internal and external, are operating effectively. How should this committee be constituted? How do we get membership to this committee, the audit committee? As a bare minimum, you need to have people who are really independent. You need to have people who really understand finance. And then you need to have people who know how the organization operates, okay? These are the key things that you consider when you're getting members or people to be on the what? On the audit committee. In terms of
And
what?
also, I remember,
Yeah.
and also remember, it should be headed by non-executive.
Sorry.
Something like. I also remember it should be headed by a non-executive director. Like
Yes.
apart from that, it's too independent, but it should
Yes.
also be headed by non-directive,
Yeah. Yeah.
non-executive.
Yeah. That's why I think in the first line I mentioned that we should have people who are really independent of the what? Of the operations of the organization.
Independent operations.
Yeah, that's why we are saying that at least two independent non-executive directors. And then you need people who have relevant, who have financial knowledge, because you're dealing with audit, risk, and accounting related matters. You can't have an audit committee that is having people who are having a legal background. How are they going to discuss those financial statements or audit reports or internal audit reports? Sawa.
So,
Functions of the audit committee, what do these people really do? They're in charge of internal controls and they can make recommendations. And you'll find that most of the times the internal controls area is looked at by internal audit, but the audit committee is the one in charge of making sure that everything is going on well. They review the internal audit function and make sure that it's operating effectively. They come up with their company's policies and possible changes resulting from new accounting standards. There are guys who are really like on top of their game when it comes to finance and accounting related matters. So if there are any new developments in the accounting policies and the accounting regulations, they need to make sure that these are blended into the organization and adopted as necessary. Then of course they review management information, financial information like monthly management accounts. They also review the annual financial statements before they are presented to the shareholders and other stakeholders. Like I mentioned, these are the guys who are supposed to be looking into the detail of any financial related report. So the financial statements go straight to these people and they spend quite some time dissecting them and making sure that before they are issued, they are actually very perfect. They review the dealing with external auditors, management, and ensuring that the internal and external auditors' recommendations are being implemented. If internal audit has recommendations, if external audit has recommendations, these guys look at them and they make sure that they are being implemented properly. When it comes to remediation for the external auditors, they normally review this and recommend appropriately. Then, of course, ensuring that the codes of practice are being complied with as set by the regulators, and corporate governance principles are being followed, and then providing a channel for whistleblowing. Whistleblowing somehow, somewhere, I'm very sure in paper 12 you learned about whistleblowing, and it always falls under
yes.
the audit docket, and as such, it is going to be falling under the audit committee when it comes to uh, governance structures of the what of the organization. There's some potential threat to the audit committee. People might think that they are there to catch management, but that's not the case. Just like in some organizations, people think that external auditors are there to catch management or to catch things, but that's not really like the case. So there's a possibility that they might be misunderstood by management. Then the non-executive directors may be overwhelmed by the detail and may fail to analyze and interpret the information. I have seen, honestly, from my experience, I have seen some directors who you give reports and they don't even review them. They just show up to the board meeting and they start asking obvious questions because they didn't read through the what? Through the reports.
The report.
Yeah. And it's of course also very costly to have some of these committees as members have to be paid for the services. You have to give them sitting allowances and and all that. Yeah. Okay. Audit engagements versus expectations of the users of audit reports. So the
Also, that will involve perfect what? Rather than you said absolute audit reports. Some expect absolute audit reports.
yes. And
Mm.
one of the things that I think that is very uh, that is very there is like it is very important to understand what the responsibility of management is and what the responsibility of the auditors is.
Possibility of auditors.
Yes,
Ah,
I
yes.
have I have
Some expect the auditors prepare financial statements.
yeah.
Mhm.
That's very good. I have I myself I have gone to clients who say that the external auditors should prepare financial statements for us. Okay. And that is not right. Okay. Uh, when you go back to Isaiah 210, it's the responsibility of management to prepare financial statements. Yeah? Okay. Then, even when you go to the Companies Act, it is the responsibility of what management, and those charged with what with the government. All right. Then I have also had some cases where in the organization maybe like there is a fraud. Okay, and then you hear someone commenting that how comes there was a fraud. I think now your background is a bit noisy. Okay, thank you. Someone says that
Mm.
how comes there was a fraud, but the auditors were not able to detect this? And then you're wondering whether the external auditors are there to do what? Actually detect a fraud. Okay, you forget that the role of making sure that you institute internal controls and avoid things like fraudulent activities happening is actually a responsibility of what? The responsibility of management. Okay, so there is all like this like this whole expectation of what the auditor is supposed to be, but they forget that the auditor is only there to assess the financial statements, examine the financial statements, and express an opinion as whether they are true and fair